Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's May 20th. And I'm Frank Curcio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. So I want to discuss something that's pretty amazing to me. You know, people love stories, love entertainment. Maybe you'll love this one. I'm going to try to make it as entertaining as possible. And this goes out to everyone who is super bullish right now, which is basically everyone I saw on financial television on Monday. The market surged over 900 points. We're closing it on the 200-day moving average for the S&P 500, where every technical analyst will tell you, buy the index aggressively. But I want to talk about GDP. Yes, I said GDP. Please stay with me. I'm going to make this interesting. Because on April 29th, we released Q1 GDP. And U.S. economy saw a decline of 4.8%. That was the largest in 12 years since the credit crisis, Q4 2008, where GDP declined 8.4%. Huge number, 4.8. I'm going to see this number revised 2 more times, just to let you guys know how economics and this data works. So this is considered a lagging indicator. It'll tell us what happened in the past from January through March. Right? So this happened already. Don't worry about it. Okay, fine. The final revision for Q1 is going to be reported on June 25th. And this, it gets revised a little bit. Not too crazy. Maybe it goes to between 4.5 or 5.2% around there. Either way, the 4.8 decline is a monster number, right? Remember, it's from January through March, where our lockdown didn't start, at least for most states, until mid-March. That's when New York announced that they were going on lockdown. Pretty sure California was after that, but it was mid-March. So you still had 2 pretty good months, and we declined 4.8%. Now let's go to Q2, which is measuring the economic activity right now, right, from April to June. And as of today, which is Wednesday, analysts are forecasting a near 40% decline in GDP, 8 times the rate of the decline from Q1. Let's put this in perspective. The largest quarterly decline on record, dating back to the 30s, that's when we started keeping track of all of this. The biggest was 10%. That was Q1 1958. Yes, I looked it up. There had 2 million people filed for unemployment. To put that in perspective, that was about 6.2%. That was our unemployment rate. That was in 1958. So at 40%, 4 times larger than the biggest decline in GDP in the history of America. And we have 30 million people that filed for unemployment thus far, which amounts to around 15% unemployment rate, which is expected to climb anywhere between 20 and 25% by the end of this month. Now, over the course of history, when we see large contractions in GDP, stay with me, trust me, I'm going to make it worth it. They're usually followed by a huge bounce. And think about that, right? Because when we look at sell-side analysts, which is the consensus, which everything's out there, right? You need to know what the consensus is. If you think it's going to fall below those numbers, then you would short stocks. If you think, the consensus is not aggressive enough or those numbers are not optimistic enough, you would buy stocks, right? So your goal as an analyst is to look at the consensus and see if you agree with it or not. And if you don't, that's how you base your trade on. And sell-side analysts do one thing. They look at historical analysis and they compare everything. That's what they do. Okay, so over the course of history, when we see large contraction in GDP, especially when it comes to these black swan events, they're usually followed by a huge bounce. When you go back to the 70s GDP, where we saw a decline, and 70 to 73, GDP grew an average of 5% annually. In 91, same thing. 2000, 2001 recession, GDP grew around 2% annually for several years, and then we all know about 2008, 2009 crisis, where GDP started growing around 2% annually through 2012. It wasn't a major bump up, but steadily into the longest bull market in history. So lots of numbers here. What you need to understand is we usually see a nice bounce in GDP after recession. That's all you need to know. Now, here's where things get interesting. Goldman Sachs published its GDP forecasts, and it's from February. So the firm predicted we would see a steep decline in Q1 from the coronavirus, but it's going to be followed by an immediate V-shaped recovery. Okay, I'm not picking on Goldman. A lot of analysts had this same call. So a quick rebound in Q2. Remember that? In Q2. So why were they predicting a quick rebound? Because this is what happened in past pandemics, where we saw SARS and swine flu. I guess over the past 15 years, they said, okay, this is the model. This always happens. GDP falls sharply one quarter, then comes right back. Then Goldman Sachs said, oh, shit, wait a minute. It's still going to be a V-shaped recovery, but Q2 GDP, which we thought was going to be a quick rebound, it's only going to be down about 5%. That was their forecast on March 15th. And then it's going to be followed by a 3% increase in Q3 and a 4% increase in GDP in Q4. Now Goldman is forecasting for a 39% decline in GDP in Q2, along with unemployment surging to 25%. Again, I'm not picking on Goldman here because most analysts had similar forecasts and they changed them, which is why I thought stocks were going to fall sharply, given the coronavirus was not SARS and everybody was comparing it to SARS. And China was much different in 2003 during SARS compared to today, where it accounts for 40% of the world's growth in 2019, and you shut it down for months. So it's just a matter of time before stocks fell. Again, they were looking at basing their models on what happens historically. And people say, well, everything, history repeats something. Not all the time. Now, when's the last time you saw the U.S., every state, or almost every state, on lockdown? Telling people not to go. I've never seen that. Nobody's seen it, right? Doesn't always follow. Or maybe not follow, but it rhymes, whatever you want to say. Not always the case, guys. So now we're seeing a huge rise in stocks. And, I get it. And the Fed printed $3 trillion already with another $3 trillion in the queue. But the move higher in stocks was based on what? That, hey, this is going to be short term. We're going to have a quick recovery. And also, we might have a vaccine, which I'm going to break down during the educational segment, since this is one of the shadiest companies you'll find in biotech. Because the market surged on that news on Monday. And now some of the leading infectious stocks are saying, wait a minute. All right, this data isn't as great as you think, and it's only phase 1. And phase 2, phase 3 is not going to come in. It's a very promotional company, CEO. They have a checkered past. But the recovery was supposed to happen in the second half of this year. So now Goldman just updated its forecasts for GDP, and that's for Q3 and Q4. Again, both supposed to be positive. But now Goldman's predicting GDP for Q3 will decline by 7%, and Q4, which GDP was expected to surge 20%, now Goldman's predicting Q4 will decline by 5.4%. So think about that for a minute, because you're looking at stocks with all the optimism, everything's opening up, that everything was going to return to normal in the second half of this year. We're only supposed to see 2 quarters of GDP declines, which is the definition of a recession in 2020. Now it's turned into 4 quarters. So every single quarter in 2020 is going to be negative, with Q2 leading the way at 39, 40%. Now, why am I bringing all this up? Because it matters to your portfolios. We're in unprecedented times. I mean, shit that's never happened before in the history of America is happening right now. And while these analysts, so-called experts, told us we're going to see a rebound in Q2, then it got pushed out to Q3, then Q4. Now it's being pushed out to 2021. And who knows if Q1 or Q2 are going to be positive. We're hoping, but could we see 6 straight quarters? And that would be insane. That's not priced in. I don't think 4 quarters of negative GDP is priced in. And we have Fed governors, one saying, hey, we have to open up the economy, everything's going to return back to normal. Another one saying we need to launch a stimulus plan immediately and release that $3 trillion. Small business are getting killed. I mean, the opinions that you're getting, I mean, these are people that are supposed to work together. I mean, what a difference of opinion. Yes, release $3 trillion. No, we don't need it yet. That's a pretty big decision. So those predicting, which are a ton of people out there, that unemployment's going to get back to normal this year or fall from over 20% to 3.8% again, pre-coronavirus levels. Guys, it's a zero chance. It's definitely not going to happen. Definitely not going to happen. We're seeing negative GDP for Q3, Q4. A lot of these jobs aren't going to come back online. We're going to still see a 12, 15% unemployment rate at the end of this year. We're supposed to be at 7, 6, at 4. Remember, we're supposed to go back to pre-coronavirus levels, even though the market's trading as not if we're going to go back, but we're going to have the best conditions in the history of America right now. But you have stocks that are ramping higher, where the S&P 500 is trading higher than where it was in March, on March 1st, when it really saw the market starting to decline, as if we discovered a vaccine already for the coronavirus, as if the coronavirus is not going to spread again with states opening back up, even though we're seeing a province in China just went back on lockdown. Started in Singapore. Look at Germany. This is the process. If everybody's home, obviously it's not going to spread. If you let everybody out, you're probably going to see it spread again. Again, very, very, very less than 1% of the populations had the coronavirus. Less than 1%. You're going to let everybody out. Of course it's going to spread. That's what we're hoping for, a vaccine or herd immunity. The stock's going high as if our relationship with China, who's by far America's biggest growth engine, is perfectly fine. As if Europe and Asia, where 25% of S&P profits come from, are not going to see a steep recession through 2021. Europe was in a recession before this happened. China, Asia, seen a slowdown in growth before this happened. Stocks trading highs if CapEx was not cut by 25% across the board from American companies, which leads directly to growth, along with marketing budgets being cut by 20-25%. So CapEx is used for M&A, mergers and acquisitions, upgrade equipment, improve productivity. How do you cut that and cut marketing and expect to grow the following year? It's almost impossible. Stocks going high with GDP expected now to decline every quarter in 2020. And that wasn't on the table. That was just on the table this week. And unemployment, GDP, retail sales at levels we haven't seen since Great Depression, the 1930s. So, guys, this is a very dangerous market where earnings, GDP, retail sales, unemployment, all that stuff was expected to go back to normal or pre-coronavirus levels, which is February 2020. But not only are they not going to get back to these levels in 2020, who knows if we'll get to them in 2021. I doubt it. And maybe 2022 now? Is that how forward-looking the market is? Because 2020 is a throwaway. 2020 was a throwaway. That's what's all right. It's gonna, Q3 was going to be great. Second, and then Q4. Now you're talking about negative GDP for Q3 and Q4. It's important for you to understand that, because why are stocks trading higher? Okay, government stimulus, you got it, but it's factored in. $6 trillion is factored in. We're talking about the other $3 trillion. It's factored in. I get it. And people say, well, follow the Fed. Never disagree with the Fed, and just that makes sense in 2010, 2011, when stocks were trading at 11 times forward earnings. They're trading at 24 times forward earnings, their most expensive valuation in 18 years. So the Fed putting all this money into the market is priced in. The vaccine is going to take a while. The quickest we've ever brought a vaccine to market is 4 years. And yes, we have 30 major companies working with smaller companies as well, collaborating together, and maybe it comes out in a year and a half, 2 years. It's not coming out in 9 months. They just started working on this a few months ago. It's not coming out probably for a year and a half and before we distribute it. Is it going to be more like mumps, rubella, which is 2 shots only and then you're good, or 1 shot? Or is it more like the flu where the strand keeps changing and a lot of times it doesn't work? 35 million people got the flu last year, in the last flu season. A lot of hope in this market. Now, why am I bringing all this up? Okay, because I try to make economics and the economy interesting, right? Because it's about you. It's about what you buy, what your neighbors are buying, what you see out there. And people just make economics so difficult. Bell curves and all this crazy stuff. But it's important because this relates to your portfolio. And I'm bringing this up because when I see guys like Mr. Wonderful, Kevin O'Leary, going on CNBC on Monday, with the markets up 3% plus after Moderna announced positive phase 1 results for COVID-19, that vaccine, which again, but leading infection doctors tore it apart. It's going to be a great educational segment, guys. Listen to after this, after my interview today. But when Mr. Wonderful, Kevin O'Leary, is going on and say, you need to be invested in this market. And if you're an investor, you're missing days like this. You're missing 30, 40% of the returns because the Fed is going to overcompensate. That's what he's saying on TV. He's telling everybody, get into the market right now at these levels. And look, I like O'Leary. I love Shark Tank. But if I was sitting in his seat on Shark Tank and he made that pitch to me to buy the market here and you're missing it, with stocks up 35% from the lows, 6 weeks ago? Valuations through the stratosphere, where it's the most expensive market in close to 20 years. where we already saw $3 trillion in stimulus, talk of another $3 trillion on the way, which means it's pretty much factored in, I would have kicked him right out of the fucking room. Goodbye. Double doors, get out. If I was on Shark Tank. Again, I like Kevin. He's a guy that criticizes everybody, so I'm sure he could take it. I'll be more than happy to debate him on this podcast. But I would have thrown him right out of the room. And telling everyone, again, that responsibility of you going on TV and people listening to you, so everyone, he was on Fast Money CBC, retired people that are on the sidelines because they have little working power, telling them that they're missing it and you need to get in, that pisses me off. I understand the entertainment factor. I understand you want to be edgy. I understand you want to say things that are opposite from, be contrarian and these big, bold calls, and that's how you get it. I get it. I'm going through the rounds now. Different TV appearances. You just had one yesterday on Cheddar, which you can watch on Curzio Research YouTube page. But guys, it's a dangerous market out there. Yes, we got out early. Yes, we got back in on the downturn, recommending names that are doing great in the portfolios. But if you look at the overall market, it's being driven by three sectors. It's technology, it's biotech, and it's healthcare. Because healthcare, you're paying those huge premiums, and the hospitals are empty because they don't have to do surgeries for anything else right now. It's great. Great business to be in. Pay your premiums in full, but you're not allowed to go to the doctor. But outside of those sectors, if you look at the S&P 500 on an equal weight basis, what does that mean? It means that obviously which stocks carry the biggest weight in the S&P 500 would be Microsoft, Amazon, and Apple, right? Pretty sure all three of those have over $1 trillion valuations. So they account for, technology accounts for, with Amazon and Google in there, account for 30% of the index. And a lot of those stocks are rising because they didn't get hurt as much from the coronavirus. But when you take an equal weight and place an equal weight for every one of those stocks, the S&P 500 is down 20% this year. So when you look under the hood, it's not as good as it seems. And while the market is dangerous, there's lots of industries that are going to play catch up. I mean, industrials, which throw home builders into that. Energy as a longer term play. You need $45 a barrel. You're going to get it probably in 6 months. I would bet. I mean, even at 45, a lot of these companies are going to go out of business. But you're going to see it higher. I mean, there's just so much supply. No one, the demand is coming back. States are opening up. Countries are opening back up. You're going to see that work off. They're cutting supplies. It doesn't take as long for oil to really rebound or cut when you're manipulating the market, right? That's what they're doing. They're cutting barrels or they're adding sometimes. You know, it's a manipulated market. Banks, it's super depressed. I love the fact that they were buying back their stock like Citigroup, which they're not allowed to do anymore. Some of them even with dividends. If you're taking money, I mean, but banks, some of them are trading on the book value, the bigger ones. A sector I would be careful with, but on my radar. They're a great inflationary plays. Guys, it's deflationary market right now like it usually is. But think Disney. Disney's parks, if I had to guess, I said this on my interview at Cheddar. If I had to guess, I would say their break even is 70% capacity. Everything else profits after that. I'm guessing. Maybe it's lower, maybe it's higher, I don't know. Disney's parks will never be at 100% again because they're going to require you to have space. That's going to take years, like three feet at least, some of them 6 feet. So what does that mean? It's fewer people they're going to allow. All right, it's 30% right now in Singapore, but 80% is going to be the new 100%. Because they just don't have the land. You're going to have that space. Again, I go to Disney a lot. It takes you hours just to get out of Disney, to get to your car. I mean, there's lines for you got to take the tram, or you got to take the ferry. I mean, forget it. It takes you 2 hours to get out of there. Everybody's yelling at each other. They don't show that in the commercials. The kid's crying. Everybody's like, oh, I'm done. And everybody yelling at you. They don't show that. It's just family. It's nice. Disney's awesome. Believe me, I have young kids. I know. Full day there for 9-10 hours in the heat. It's hot in there in December. Gets crazy. Everybody's tired. But what is Disney going to have to do, right? Because I'm talking about inflation here. What's Disney going to have to do? They're going to have to raise prices to compensate for that. Maybe they get it. Maybe they have pricing power for the parks. They're not going to have pricing power with streaming. Absolutely not. But Disney's just one example of companies, restaurants who are going to have 80% capacity, right? They have to take out tables probably for the next 2 years. That's a huge hit on margins. And that's the difference between some of these restaurants and bars staying open or going bankrupt. So what are they going to do? They're going to raise prices. You're going to see inflation, guys. You're going to see it. May sound crazy because we haven't seen it, even though the Fed just put a bid on this market, low interest rate, zero interest, forcing people to take out debt and become more leveraged. Yeah, makes sense. Interest rates low. It's such a perfect environment that you have Apple and Microsoft, two companies that have the greatest balance sheets in the world, are issuing bonds, right? Because interest rates are so low. It just makes sense. There's great inflationary plays, which you're probably going to start seeing a lot of those names go higher in 2021, even small cap growth names. If you're a Curzio Research Advisory member, I just posted a bunch of these screens listing more than 100 stocks that look attractive that are on my watch list. Also some that aren't attractive, including names that are likely to cut their dividends. All screens on my watch list. So despite stocks ramping higher here, again, which is concentrating just 3 sectors, I'm finding lots of cool ideas that have been unfairly beaten up that have huge upside potential. So great risk rewards. And we're going to get to one of those names right now. Today's guest is Scott Cohen. He's the executive chairman of Wrap Technologies, close friend. So he's going to be great advice for my business. He's a hedge fund manager with 20 years plus experience in institutional asset management and wealth management, runs his own $300 million fund. Very, very successful in investing in early stage companies and small caps. He takes big stakes in these companies. He helps run these companies. And again, incredibly successful. And now his next project is Wrap Technologies. So if you're a subscriber to Curzio Research, you're familiar with this name. How do I know that? Because by far I get the most emails on it, because it's a really exciting story. The stock was ramping higher pre-coronavirus, surging as a signature product called a Bolo Wrap, which is a non-lethal device, shoots out Kevlar rope and wraps someone up with like hooks on them, instead of using a taser. And a taser, if you have heart problems, you're going to die. There's over $1 billion in settlements that have been made that police departments had to pay and states had to pay because of the use of tasers. This is non-lethal. Taser is called a less than lethal device because people have died from tasers. This is the only non-lethal device out there. It's being tested in over 140 police departments, including L.A. and just police departments all over the world, and now it's deployed in the field. But like most small caps, the stock took a pretty hard hit over the past few months, down about 35% from its highs. So I wanted to bring on Scott to give you an update. If you're not familiar with the Bolo Wrap or Wrap Technologies, which is the company, definitely give this interview a listen. So let's get to that interview with Scott Cohen right now. Scott Cohen, thanks so much for joining us on Wall Street Unplugged.
Thank you, Frank. Good to be back.
Well, we know each other for a few years now, and we're introduced by James Altucher, who knows I cover small cap stocks in one of my newsletters. And he said, Frank, you know what? Take a look at this product. Take a look at the guy. I'm not even going to tell you too much about it. Make your own decision. The product's called Bolo Wrap. I loved it. Most of my audience knows this device because we did a big promotion around it for our newsletter. But can you explain or describe it for people who may be listening to my podcast for the very first time?
Happy to do so. For those that haven't seen the video, it couldn't be any more self-explanatory. It is a wrap, looks like a lasso, firing out of a handheld, what looks like a launcher, almost like a phone, an iPhone, and an 8-foot piece of Kevlar comes out with 4 prongs on one side and 4 prongs on the other, and it simply wraps you straight up where you can't move. Think remote handcuffs. Think remote restraint. It comes out at over 600 feet per second. It is, Frank, when you first, we were just talking about that, when you first used it, when we first shot you, those were early days. That was probably 2.5 years ago. The product has improved so much so from the distance, from the strength of the wrap and the consistency of the wrap. It's wrapping over 90% of the time. So I'm really proud of the people that helped develop this product and advance it to where it is today. So I hope I did a good job of explaining it, but basically by the time you press this button, the trigger on it, you are wrapped up where you can't move, and you can either hit them low around the legs or that'd be up towards the waist. Remote restraint, air cuffs is what we like to talk, how we like to explain it.
I know, like the due diligence I did is I went there, I actually got shot by this device, which, pretty crazy at the time, but I really wanted to see how it was, and you get wrapped up, and it was unbelievable. But why do police departments need something like this when say they have taser, right? Because taser's considered a non-lethal device. Actually, it's not as lethal now, which they changed. But talk about the difference between taser and why this is important to get it on the belt of every police officer out there.
Taser is a great device. It came in the late 90s. Actually, it was available many years before that, but it really came on the scene in the late 90s, and it's very effective. The problem with taser, it's a high use of force. In many states, it's considered to be a deadly use of force, not a non-lethal use of force. I say it's less than lethal. But in some states, New Jersey is one of them, where the use of force is considered to be extreme, the highest level next to a gun. So just starting from the way it's defined on the use of force continuum, way lower. We're talking about handcuffs grade force. So that's for one. It's a very different category of a device. Now, it's the consistency of our product is also something you could see. You Google, just look up the fact that taser is working about 60% of the time, and our product's working close to 90% of the time. So the consistency is another big factor. But at the end of the day, when you're using a taser and if it strikes you in the wrong way and deploys in the wrong way, where it has in the past, in fact, 12 or 1,300 people have died from it, that is going to cause some real litigation that's resulted in hundreds of millions of dollars of payouts by states, probably much more than that. I don't have the grand total. So even if you don't get hurt as a result of taser, you're being sued for just using that level of force when you should have, or when there was alternatives. So our tool is an alternative to that higher use of force. It gives the police officer another tool, another way to apprehend or to de-escalate the situation. And that's what's needed right now, because the police officers don't have choices, or that many choices. A gun is a choice. A taser is a choice. But they don't, besides that, it's pepper spray and they're going to handcuffs until now. Until now, you have a remote way to restrain somebody. And that tool, that option, is what is critical in today's law enforcement business.
Yeah, Scott, you know what? It was one thing for me to look at this product and say, wow, and then interview police officers, some of the top police force officers I interviewed personally, which I got attached to because I knew if they had this device, it would have saved lives. And a lot of cops, almost every cop doesn't want to take out their gun, even if it's a clean shoot. And I just saw something recently, too, because there's one thing where you look at the device, another thing to look at the actual company and the stock, right? So what impressed me was when I look at law enforcement officers, where I didn't know these statistics until I talked to the police officer I interviewed and yourself, where 1 in 10 police encounters involve mentally ill, 1 in 4 fatal police encounters involve mentally ill. And I didn't realize how big those statistics were. And then today, now that I know those statistics, I just saw not too long ago, there was a person in Walmart. He was swinging a bat, and it was a clean shoot. They tasered him. And then after he took the taser off, it didn't work. And then he kept approaching. He said, I'm going to hit people. And they had to shoot him. And for me, when I look at that option and I look at the bolo wrap option, because taser didn't work, and the fact that they found out this guy was mentally ill afterwards, it just seems like this is a product that makes sense and saves lives, doesn't it?
That's certainly the way we look at it. You know, even pulling out a taser and aiming it at someone it's an aggressive that's an aggressive move for an officer. So when you pull out that taser and aim, we've seen that in many cases can escalate the encounter. Seen many videos in police cam of situations where the taser is coming out early and maybe even fired, and if it doesn't stick, now you've escalated to a point where the encounter's just got even more dangerous. And there, your only option is to go with a gun. We're suggesting there's a choice before that ever gets to that point. There's a choice that the officer now has before going to a lethal option. And that choice hasn't existed until today. And that is the opportunity, because that incident that you're discussing in Walmart that just happened a couple of weeks ago, you're right. That could have been avoided. And you know what? Nobody would even have known that happened. None of us really knew what these encounters were like until recently, where everybody has a video camera. So now every encounter is being filmed. And it doesn't look great when you're in front of a judge. How do you think the jury is going to feel when they see that videotape, thinking, and they know there's a tool that could have been brought out earlier that may have avoided that incident? Because the financial damage to that state and the emotional damage to that officer is you cannot calculate it.
Now, Scott, it's been 2.5 years since, you said it earlier, since I first learned about Device in your company. And it's, you could say it's a long road, maybe only 2.5 years, but it is a long period of time. Talk about the accomplishments when you're looking at now you have a product, now people want it, now you go to a police department. So now it's, we got to get our manufacturing facilities ready to go, getting the right team in place, raising cash to grow the company, and even having some of the biggest names in law enforcement and even politicians strongly endorsing your product. I mean, talk about the last 2.5 years of how far you've come, because from then until now, really incredible to see your growth.
Great. Happy to do so. So 2 years ago, we had $3 million raise, give or take 2 years. So we had roughly $3 million on our balance sheet. Before that, we had $500,000 on the balance sheet. We had a product that was really in prototype phase. Lots of things wrong with it. And started to get the semblance of a team, mostly developmental, the stage of company. I mean, very much developmental. But we kept innovating, product kept getting better. We've been fortunate enough to be able to take enough capital in where today we have over $15 million in cash. We've been able to get in dozens of major cities. Some of the biggest, best known departments, innovative departments in the country are using our product. And here's one very critical point of our company's history is now we have reps. We're getting reps in the field in big and small departments all over the country. And a lot of times it's problematic when we can't talk about it. Specific those encounters are going to be in front of judges or there's investigations going on. There's a number of different situations where we cannot go and promote that. But the product's being used. We didn't have it. We have a stable product. We have a balance sheet. We have a team. The founder, the architect of Taser, Tom Smith, came and joined us only a year ago. We built up distribution domestically, internationally. We're not talking to small departments overseas. We're talking to countries. Countries you're talking about standardizing on this. So you want to talk about, forget about 2 years. How about last year? We didn't have a product in the field. Now we're in over 80 departments deployed, some of the biggest in the country. And the more and more, the only thing that's holding that back is training and budgets. But now all of a sudden, grant money's appeared as a result of COVID, where now the departments are able to apply for the grant money to purchase these and to get the training. So with the political environment wasn't anywhere near where it is today. People don't want to be tased. People are judging the use of force today in their living rooms, in the media, and they don't like what they're seeing. There needs to be a lower use of force, an option out there for people today. That's the difference of where we were 2 years ago. That's the difference where we were a year ago.
Yeah, it's incredible to see, guys like not only Dom DeLuca, chief of police is retired, and Thomas Smith, co-founder of Taser. And the thing is, I covered Taser, which got me excited because I remember those early stages when it was a single-digit stock trading $3, $4, $5, and it's tough to build up those manufacturing series. I remember the early orders, and the stock wouldn't do anything because it was based on the orders. I mean, the orders were all over the place, so you didn't have recurring revenue or things like that. But just to have somebody with that experience to help avoid a lot of the mistakes Taser made, as every company makes during their early growth phases, is I think was huge. But you brought up the coronavirus, and how are you performing through this, right? I mean, is the police department still active? Are they cutting back? How has it impacted you? Some companies, this could be, very, very rough, especially smaller companies like yourself. But other times, a guy like you has experience. I mean, it can lead to some great things, right? For those who survive like a black swan event like this, including, you see productivity gains, knowing how to cut costs during extreme times, who's on the ball, right? Leadership from management, employees. Have you learned anything from this, and how is coronavirus impacting you?
Yeah, good question. So in many ways, positives and negatives. Let's start with the negatives. The business that we thought we'd have now has been pushed back. Another negative, we can't go out and be in front of departments. We can't be training hands-on like we have been in the past. We're not, so the combination of not being able to be on the road in front, both on the training and the sales front, has definitely slowed down the sales cycle. And I would just say slow down. And even, I mean, one of the big things is the wraps. We were getting a wrap a day in the beginning in some of the big and small departments. But the problem was that now people don't want to be, the departments don't want to be wrapped. They're not looking to wrap people now because they're just letting them go. There's no one's in the streets. If someone's causing a problem on a lower level of crime, they're not arresting them. They're just letting them go because they don't want to take them into custody, thinking that there's a chance they might have COVID. So less people are being arrested for minor crimes. Domestic violence is not happening as much. So that's been problematic for wraps in some departments, in some states, not in all. So, but let's now talk about the positives. It turns out our product's fairly self-explanatory. You can see it and see what it does. So we're able to demo this product remotely through Zoom, and it's working perfectly. So we're still getting out there. Grant money now is available. So you're getting the federal government and other grants are now available for the purchase of the devices. Okay, so that's something we didn't have. And now, as a result of the anticipation for increased crime because of unemployment, which always happens, because of other economic factors that are out there, there's an anticipation that there's going to be more petty crimes, and therefore they need, again, alternatives. So we're being contacted. They're contacting us, countries from all around the world, and departments here in the States reaching out to us, asking us how we get trained, how do we get devices. We've never quoted. We're quoting this on a. I think we've never quoted the devices more than we're quoting now. So it's telling me something. It's telling me there's more interest. There's anticipation that there's going to be an environment where more crime is going to take place. And now there's money to pay for these devices. And there's a real willingness from departments and countries to want to get this out there like we've never seen before. It's accelerating. All the work that we did last year, the year before, is now we're starting to see the benefits of that, because now the phone's ringing, the calls are coming our way. We're not having to go out to them, which is very different from where we were even 4 months ago.
Yeah, and I know from covering your stock that you're in 140 plus police departments. They received the product thus far, but you mentioned briefly about internationally, because I know this isn't just a U.S. story. In fact, when I look at it, I think it might even be maybe not bigger, but a huge international story, because the laws there, especially in Europe, when it comes to carrying guns for police officers, is a lot different, right?
Very different. Let's just take the UK as one example. The UK, in the UK, I think the number was 35,000 knife incidents, the violence with knives, and the police have they're not carrying guns in many cases. So when somebody brings a knife, when there's a knife involved in an encounter, does it make sense to start out with a gun in that situation? Well, it depends if it's aggressive or not. I'm not trying to weigh in on how they deploy use of force, but if they're not comfortable with their tasers, and if many of them don't have guns, what are the alternatives? This has been the first alternate taser. And so in Europe and overseas, they don't have guns, and many of them don't have tasers because their countries have laws against, they look at it as a human rights issue. So without guns or tasers, they're using handcuffs, billy clubs, and pepper spray. Guess what? Now they have an option. And that's an opportunity for us, because almost every department in the States, people have guns. Well, that's not the case overseas. And in fact, it's so much, it's totally, just taking a step back. They not only have guns, but many of them don't have tasers. So this just becomes a beautiful opportunity for us to step in with a solution. And that's why we're being so well received over there. The sales cycle is a little longer, obviously, but it's not just going to be 10 units or 100 units. You're talking about much bigger opportunities when countries embrace the tool.
No, it definitely makes sense. It just, to me, and speaking to you a lot, I mean, you've helped me so much, even with my business, being able to pick your mind in so many different things and been such a good friend. But just, hearing those stories and some videos that you send me where, think about it. If you don't have a gun and somebody has a knife, right, and you're a police officer, the guy's swinging a knife at you. I mean, what are the options? I mean, taser if they're using it, or a wrap or something, or it's just when you don't have a gun, I never knew that. I mean, that's pretty scary, just when you think about it. But I want to get
you were involved in taser early, okay? You were there for the rise. It went from $5 to $105 in 1 year. They had a couple incidents that took from 500 units to 2,500 units to 9,000 units. It jumped from 2,500 units to 9,000 units, sent the stock up from $5 to $105. I'm not saying we're going to do the same thing, but that opportunity is out there for us. And I think once you get one or two big countries or departments to take this on and go full deployment, departments here in the States, small and large, the amount of people that will be putting us on the belt, these get into massive numbers.
Now, you have well over 2 decades of experience. You've brought a lot of companies public. You've been part of a lot of companies during the early phases, which is why with us, with Curzio Research, I lean on so many different people. You're one of them to really help me out when again, you need those people with that kind of experience that you trust. And you've been amazing for me. But since you've been part of a lot of companies involved during the early growth phases, as a, you say, entrepreneur, leader, we all have winners and losers that we invest in, right? It happens to everybody. But what makes Wrap Technologies different, or what do you see in this company that has you so excited compared to a lot of other companies successful that you've even been successful with or not so successful with?
Let's start at the top. There's a massive social element here. You are providing a tool where the world can be a safer place. There's been such debate about policing, and it won't stop. It's some of the most watched TV shows are about crime, and that's just not here. That's overseas as well. So to be able to come in and have an impact with a product like this in law enforcement, which ultimately saving lives, is just a great. It's an amazing feeling, and it's hard to articulate, but it's something you're doing good for society. You're going to make society a better place and the world a safer place with a tool like that. It starts there. The insider ownership here, myself, Woody, Jim, and David, we're big believers. We own half this company, so we put up our money, and it's unusual to have a company that has 50% inside ownership. So that's an element that I always look for. And most companies I get involved with, you just don't have the executives that have had this kind of success in their lives to be able to maintain that kind of position. And the one thing that you just have to understand, it took Taser 30 years to get to where they are today, maybe even longer. Tom likes to talk, I think 30 years since him and his brother are involved. It's taken us 4 years, which to some it might seem like a long time, but we've accomplished more in these 4 years. I think Tom said it took Taser 20 years to do what we've done in 2. So when you think about this, it's been that long for a new device to come along that could have impact on law enforcement. That's a beautiful thing. There's nothing else coming. Maybe there will be a couple years down the road, or 5 or 10 years, but there's no We don't hear of anything else that's competing with this device. So when you don't have competition for a product, and it's just blocking and tackling, time, policy, training, education, and that is the biggest risk, you better have a balance sheet to wait it out. But when it happens, it's going to happen big. It's going to happen. It's going to happen in a flash. And all our shareholders will be rewarded if you own 1 share, 100 shares, 1,000 shares, or 100,000 shares. It doesn't matter. We're just at the beginning, even though 4 years doesn't seem like the beginning. But when this takes, and there's that one incident that's caught on national television, and everybody's talking about why doesn't every cop in my town or in my city or in my state have this device? When that conversation starts happening, you know we've made it, and our stock will not be at $4. It will follow suit of Taser's $100, and I would like to believe that we could do much more because it's got broader appeal. It's got broader application. It's safer. It's more appropriate for today's environment. That's what it is.
Yeah, no, and I could tell even from your excitement over knowing you for how long, and you being involved in this project is great. So I guess we'll finish with this. What are some of the next steps? I mean, you briefly touched up on this, but in terms of growing the company, say over the next 12 months to 18 months, right? I mean, say the coronavirus, okay, it is people lockups or lockdowns, whatever you want to call them, have ended. Most of them people are going back to work slowly, assuming, say, we get a vaccine or even like 9 months from now, I'm pretty sure that you're going to be able to really go to these police departments and train these people again. So what are the growth plans in terms of, over the next 12 to 18 months for you and RAPP?
Continue to support the distribution network. We did over 60. In the last 6 months, we did over 300 because of the distribution network. So we basically effectively have now hundreds of salespeople versus only 3 this time last year. So support that network. Get more chiefs talking about their success with the RAPPs. Remember, we were just talking about the chiefs were only able to talk about them bringing the product, demonstrating it, and them hoping they were going to be able to deploy the product in the future. Now we have deployments and success stories. We need to press that. We need more of those. And that's happening now, and it's going to continue to happen. And then we need to continue to train, beef up training even more so, and think about smart partnerships in the future. People that we can sign distribution deals with, people that we can partner on technologies with, complementing the tech that we have, and the key asset is being on that belt. And once you're on that belt, you can go in many directions. And there's companies, a lot larger companies than us, that are very interested in that real estate and know that we're getting ourselves that real estate right now, and they want to be positioned with us. So I would look for partnerships in the future. I'd look for more RAPPs, and obviously you're going to see sales reflect in those numbers. It's all just math from there.
Yeah. Well, Scott, listen, we went through a lot. We covered a lot. I usually like to keep these at 20 minutes, went a little bit longer because, it's just learning. I want everybody to really learn about this, because for me, the biggest thing is when I went there, it was about the stock price. By the time I saw you interviewed police, it was personal to me, and it really touched me in terms of interviewing these police officers and knowing that, just seeing their faces. And it wasn't a joke. It's these people who don't want to take out their guns and said, wow, this would have saved lives, and just interviewing them, seeing them. I didn't expect to get emotionally attached to it. But even as an investment, which this podcast is about, I think it's amazing. We'll bring you on at a great price here. But for just learning so much about this and really getting attached to it, I really appreciate it. It was great meeting you, and I love the success that we've seen over the past 2 years since we first really went out there and started recommending this stock. So I really appreciate you coming on, buddy.
Frank, you were one of the first guys to cover us, and you were one of the first to pick up the story. I'll never forget that. And I'm just and at this moment in time, this is the opportunity. There's so much more clarity on where we were a year ago to today. So thank you for your support. Thank you for recognizing, seeing the difference in this product and what could make us a tremendous success. So I thank you for spotting us, and I thank you for staying connected with us. Appreciate that.
Nah, no worries, bud. All right. And I appreciate you coming on, and I'll definitely talk to you soon. Thanks, man.
Okay. Thank you, Frank. Be well.
Okay, guys, great stuff from Scott. And quick disclosure, I'm long wrap. I got it about 2 years ago. I don't plan on selling this anytime soon because I believe in the growth model. I believe in the story. It's a device that saves lives. I mean, the product, which is a much better alternative than Taser, and so just restraining people with mental health problems. It's such a big issue. 1 out of every 4 calls in New York is mentally disturbed problem. And these are people that could just come at you and walk at you with a weapon. And, some of them have heart problems and tasers. Sometimes tasers don't work. Like I described, and the guy for Walmart got tased and just pulled it off of him and started swinging. What do? You got a gun. That's it. That's all that's left. This wraps you up, shoots fast as a gun. They have new technology coming out. They're looking at different because I got shot by this device, very, very loud, extremely loud, like a gun. So they're working on the noise aspect because shooting this thing in the city might scare the hell out of people. So you also want things that are quiet. And just interviewing some of the top police chiefs, police officers, 30, 40-year vets. I mean, I really got the story. I wasn't kidding when to me it was emotional. I was like, wow, these guys, it's tough being a cop. I know right now if you're in the media, especially a millennial, cops are the enemy. They're the worst. Guys, look, 3% of them are assholes, we all know. But most of these guys, I mean, they risk their life every day. And they don't get paid a lot of money. And they just get shit on, basically. And it's terrible. And I have a lot of friends. And I have to tell you, probably 15 to 20 I grew up in New York, I would say about 5% of them are a-holes. The rest are really good people. They help people. They love their job. They really, they used to love their job. But just to see, I mean, nobody wants to pull out their gun. Nobody, I mean, even if it's a clean shoot, I mean, that's going to impact you forever, taking somebody's life, even if it's a clean shoot. So when I see this, this is something that I got attached to from a stock perspective. I like it a lot. But look, don't go all in on this stock. I mean, Scott is an upfront guy. He said he highlighted the risks. There's a lot of travel involved and training involved, which you're going through, which has been halted. But you're still seeing this deploy. You can still see lots of orders coming in, but it is a small cap. Yes, it has huge growth potential, but it's generating little revenue right now. So only put money in it that you can afford to lose. And you can even limit that by putting a stop on it. But just, be careful. It's not a guarantee. I mean, I mentioned during the interview I followed Taser from its early growth stages. I mean, back in the Kramer days. By far, one of the biggest, I would actually say it's the biggest roller coaster ride I've ever seen in the stock that I recommended. I mean, this is a stock that went from 3 to 8 to 4 to 2. We were adding back and forth and just, but eventually the long-term story made sense. And now when you look at Wrap today, the model is the same. I mean, it's a device similar to Taser. It's going to save lives. They're using a gun. Helps police officers in very tough situations. And the fact that they got the co-founder of Taser as president, I mean, he's helping this company. He's helping Wrap avoid the mistakes Taser made early on because it was just like no news flow for 2 months, and it's easy to short the stock. And then they say 150 orders from this police department. Then, it might take another month. Then they had say, 1,000 orders and 1,500, 10,000 orders and no orders for 2-3 months. There was no recurring revenue, recurring orders all the time. So it was really difficult. And you saw the movement in the stock. But eventually, it made sense. But I want to thank Scott for coming on. Really great stuff. Again, he's helped me tremendously in my business, just being able to pick his mind, as well as, several other people I really, really respect. A lot of those people are subscribers, too, that I got to meet. So that's why I always encourage you guys to email frankkerseyresearch.com. Let me know what you thought. Again, be careful. It's a great stock. We have it in our portfolios. I think it has tremendous upside. I don't want to bring this, Scott on with the stock, trading at all-time highs. And, no, it's trading at a lower level. It's a pretty good price. But, again, if you're going to buy it, just be careful. Just put a little bit of money in it. Don't go crazy. Because a lot of small caps you're going to see make their way into both of my newsletters. One, Kersey Ventures small cap. And Kersey Research Advisory is mostly large cap, few mid caps. But you're going to see small caps make it into both of those newsletters because that's where the opportunity is. This is a sector that's down the most. A lot of these companies have still gotten crushed, and they're starting to get back, not to normal, but you're going to see that growth start again, which is why a lot of those small caps are trading at such high valuations. So that's what I'm looking right now. Let's move on to my educational segment. I posted a live video on my Twitter feed. Feel free to tweet me at Frank Curzio on Moderna. The company that you should know by now, right? On Monday, posted positive phase 1 results for its COVID-19 vaccine. Everybody went crazy. The market surged 900 points on that news. And also, the Fed day before saying, hey, we're going to put a bid on the smart. We're going to do whatever it takes. Yes. Okay. Kind of factored in already with $3 trillion in the queue. But it was mostly the Moderna news that pushed the whole entire market higher on Monday. Now, Moderna was already up huge. It went from $17 in January to $60 before these results were announced on Monday. And after they announced them, it surged another 20% in the news. And the stock went as high as $80 a share, giving it a market cap of more than $30 billion. $30 billion market cap. Moderna does not have any FDA-approved products. They don't have a product on the market. Generated $51 million in sales over the past 12 months, probably through milestone payments and things like that. But if you're looking at price to sales, this company is trading at 575 times sales. And people say Square, which is a company I like, is expensive. It's expensive, and you saw a couple downgrades, still performing well. This is a company that's trading at 8 times sales, and Square is expensive. Moderna trading at 575 times sales. Now, Moderna did the smart thing. You got to give management credit. One day after releasing this news, the stock at trading at 80, it announced a huge secondary offering, 17 million shares at 76, so they raised about $1.3 billion. Okay, that was yesterday. That was Tuesday. Now, late Tuesday, leading infectious doctors started questioning the data, since everybody was listening to the CEO, who talks a great game, who's always talked a great game. Moderna's got great technology. It's a good company. It's raised a lot of money, one of the most capital raisers in biotech over the past 3-4 years. RNA technology. But the CEO's known for being very highly promotional. But when it comes to biotech, it's about the data. And when they looked at the data, they're like, it's okay. And CEO was like, hey, it looks like we're going to have something to the market by the end of this year. And they were like, no, you're not. I mean, phase 2 is going to take a while. Then phase 3 is going to take a while. Then you got it, again, safety, efficacy, all this stuff where these results were okay. Not to mention, right? Moderna's using RNA technology. Won't get too technical. Basically uses proteins to help cells fight against diseases. Revolutionary technology. A lot of companies are into it. But this technology, specifically RNA, it's never been used successfully to create a vaccine, ever. People are just assuming magically, again, it takes 4 years was the quickest we brought a vaccine to market. 4 years. That was mumps. But it was 1967. Now, brand new technology. Are we really assuming that it's going to be less than a year? Are you crazy? It's going to be less than 9 months? I hope it is. I hope they're right. But this company at $30 billion is pricing in that this thing is already approved, being distributed like crazy. So now what happened? They did the offering at $76 yesterday. Stock's trading at 70 today. It was at 80, and people are like, yeah, 76. All right, I'm in. That's cool. Morgan Stanley was the main underwriter, the lead underwriter. Now it's trading at 70. You're already down the stock. Again, so much for those people buying in. Don't they got a great deal at 76? Maybe they will in the long term. I don't know. But let's look at the forecast really quick, because this is where things get interesting. So Goldman Sachs, very positive. Everyone's very positive. The analysts are positive. I see this with biotech all the time. When you see biotech, the best advice I can give you is sell enthusiasm. Stocks move higher through phase 1 and phase 2 trials when they get approved than they do after they get FDA approval. Human Genome Sciences is a perfect example. That stock went to $30 a share. Partnerships with Glaxo. Only drug on the market to treat lupus. Trade as high as 30. As soon as it got approved by the FDA, everybody thought sales will ramp up. It takes a long time. You have doctors and scientists. Now you got to turn into a real company, manufacturing, distributing. Doctors don't know a lot of this stuff. You got to hire sales teams, sign deals, collaborations to try to get this drug out as quick as possible. And the next 2 years, stock went to 8. And that's what we recommended it. This was in phase 1. It was like 2012. And got very, very lucky. 3 weeks later, got taken out by Glaxo for $3 billion. It was like a 60, 70% gain. But the enthusiasm behind this stock at $30 billion without an FDA-approved product with a history that has a checkered past. And now you go into reports here, guys, and I read this stuff. You guys don't have access to this stuff. I'm going to show you. Because Goldman has a $105 target price on this. Love the results. It's great. It's awesome. This is right after they released. So they see revenues going from, again, the past 12 months is $51, but if you're using a year-to-year basis, it's $62 million. They see revenue going from $62 million to $8.4 billion in 2021, next year. And a $10.5 billion in 2022. I've never seen anything like that in my life. And I know if you produce this and you do the numbers of how many people are going to take it, depending, it could be 5 billion people, or, again, if it's something that's mumps, rubella, measles, that you're not going to have it at all, you're going to see much more people take it compared to, well, we're trying to get the strand right for the flu, and like 30% of it works when not everybody takes it. Big difference in revenue. But Goldman Sachs, $10 billion in sales, $8.5 billion next year. And they're not even phase 2 yet. Now it gets even better. So BMO, they also have a buy rating on this. And I love this. This is awesome because they have a discounted cash flow model, which they all do, right? They push out the years of discounted cash flow. Stay with me. BMO says that their DCF, discounted cash flow model, includes risk-adjusted cash flows through 2034. Who knows if Earth is going to exist then? 2034. It's 2020, 2034. That's how much their model goes out for. So I said, all right, let's have some fun. Let me see what these numbers are. And when I look at their numbers, they're saying by 2027, and even going into 2030, so you look at these numbers, sales are expected to go, so 2023, they have $6.7 billion. Okay, that's 2023. Goldman has next year at 2021, 8.5. But then they have 2030 that this company is going to generate $30 billion in sales. $30 billion in sales. They're going to have to give some of that away because they're working with the government, right, to fast track this. But even better, which I love, is by 2030, I'm just having fun with this because this is really cool. 2030, cash and cash equivalents are going to be $106 billion on the balance sheet. Just to put that in perspective, Apple, the greatest company in the world, $250 billion in sales, has $94 billion in cash on its balance sheet right now. Moderna, no working drugs, phase 1 approval, with much larger competitors trying to bring a vaccine to the market. $106 billion on its balance sheet in 2030. It's awesome. I mean, just to see some of this is crazy. But my point of this segment, and by the way, for those long Moderna, great results. I believe in them. It's awesome. Management, I'm not too sure if they believe in them. Given the CFO, Lawrence Kim just sold 260,000 shares from the 15th to the 18th. So 3 days, right? Right before that announcement came out. Pretty cool, right? Selling a lot of shares. I guess you're not as optimistic as BMO or Goldman Sachs or all the other analysts. That's okay. Lock in a couple $1 million for yourself. You're good. Why am I bringing this up? Because you're seeing vaccine companies. It's a crazy market. Based on this data and the companies that are using that RNA technology, those companies should have got murdered. You see that all the time in biotech. If a company comes out with something that's positive on a certain drug and it's better than the one that's currently on the market, that company usually gets hit. You get hit 10, 15, 20% sometimes. As a company with the data just reported, maybe it's phase 2 or positive data, it will go up 30%. And there's a limited market, right? There's always a limited market for it. It's a total addressable market. If you're coming first to market, you're going to take most of that market, which means a lot of the other vaccine companies are going to be in big trouble. Maybe a couple of other ones bring a vaccine. They're trying different vaccines. Again, whatever. There's different drugs for every disease out there. But the fact that this is a different circumstance and a vaccine coming to market is going to be distributed immediately to as many people as possible as soon as we get that okay, it's going to be hard for these other companies. But you're seeing the whole biotech sector and all these vaccine companies. I mean, today, Inovio, which I'm very familiar with, decent company, little shady past, again, very promotional, positive clinical trial results, and the stock surged. Clinical results. I mean, pretty crazy. And so this is a market. If you're getting into biotechs, and I listed in the screens for CRA, the pure plays, okay? The pure plays. So the Modernas, and I think there's about 15, 20 stocks on that list that are pure plays, meaning if they don't get the vaccine, these things are going down 70, 80%. You should take a look at that and buy a basket of these if you're going to go in and use money that you could afford to lose. Because everything's exciting right now. Everything is cool. You hear it on TV. Biotech is great. I cover this sector for a very, very long time, guys. A lot of these names are not going to have the vaccine. It's only be one, maybe two, maybe three. I mean, 4 companies dominate the entire vaccine market right now, 4 major companies. So take 4, maybe, that come up with a vaccine, a couple of vaccines, whatever. The rest of them, especially pure plays, are going to get murdered. Just understand that risk reward going in. Because right now, nobody cares. Oh, just coronavirus and decent results. And not even, I mean, how can Moderna go on TV and people didn't even look at the data? They didn't even look at the data. You heard that by the end of the day, Monday, that Moderna came out with those results. By Tuesday afternoon, late afternoon, when analysts and professionals and experts in that field, infectious diseases, started looking at the data like, wait a minute, this wasn't that good. It took a day and a half and they'll look at the data. And the market didn't care, reacted and say, wow, this is great. We're going to get a vaccine in a couple months. No, we're not. No, we're not. When it comes to biotech, guys, be very, very careful. I spent a little bit more time than expected, but I just want to put in perspective. I have access to a lot of research, a lot of great biotech analysts. It's a sector I covered for a very long time. Did very well investing in biotech for my subscribers and myself over the years, past 20 years. But right now, risk reward is very, very dangerous. There's only going to be a couple of winners. Not all of them are going to be winners, especially the pure plays. And you guys know which ones they are. You're invested in them. Just be very, very careful. Okay, guys, you want to see more Frank Curzio, which you probably don't. You can on my Curzio Research YouTube page. And I was just interviewed on Cheddar, a good 7-minute interview, talking about TikTok and Disney and the problems with Disney. Amazing that a key executive, his name was Kevin Mayer, head of streaming, which streaming is the greatest business for Disney. He left. He left streaming. I mean, some of you say it wasn't a surprise he got passed over for the top job, but if streaming was really that great and you're going to make that much money off of it, I think he would have stayed. But he went to TikTok, a company that's growing tremendously, but has a lot of regulatory problems. A lot. The U.S. is all over them. So what does that say about Disney? But a lot of these interviews you're going to be able to see on a Curzio Research YouTube page. Very, very good stuff. Original stuff. And also, feel free to tweet me at Frank Curzio. That's my handle. Like to post on Twitter a couple times a day, 2-3 times. I also do live videos. Trying to do them every day. But sometimes it gets a little busy. I'm writing newsletters and doing some research. So I would say at least 3 times a week, you're going to see live videos. I'm going to try to do them a little bit more than that. But those are 2 other outlets that you could find me on. So, guys, a lot of stuff to digest. Let me know what you liked about this podcast because I know the stories are cool. I know I could, bringing in stocks, bringing in CEOs, things like that. But the GDP story is very, very important. I want you to understand it. Hopefully it wasn't too boring for you and also getting really into the numbers of Moderna. Again, I could break it down even easier for you, talk about different things. But those are 2 big relevant events because those numbers for GDP for Q2 just went down tremendously. Expected 40% decline now. And Q3 and Q4 got lowered across the board that we're going to see negatives. Very, very important because this market is trading as everything's going to be good in the second half. Obviously, it's not. And hopefully it's going to rebound in 2021. I don't know if that's on the table. So we're at Q2, Q3, Q4. Now it's 2021, Q1. Let's see if it happens. I don't know. We'll see. And also Moderna, that news drove the markets higher, even though a lot of this is saying not that it's full bullshit, but the markets went up and they came down Tuesday, and now they're bouncing back up on Wednesday. So you really need to give up that premium from the Moderna news. So again, I want to talk about relevant things that are very, very important. Just give you my opinion, which is normally different than what you're hearing on TV, but let me know what you liked and didn't like. You can do that by emailing frankcurzioresearch.com. So guys, thanks so much for listening. Really appreciate all the support. I'll see you guys in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.